What we love about you is you bring the historical context, the research, the data, and push us forward. Are there any alarm bells ringing as we go into this important week?
Yeah, it's interesting. When you look at the data, I mean, everybody highlighted the fact that numbers have been coming up into this earnings season. And interestingly enough, technology has now re-accelerated from a sector perspective back into the top quartile of its history. And as much as we want to be skeptical and say, well, doesn't that usually mean that we have to mean revert? That earnings growth typically does prove durable when you study history. The more interesting data comes with the fact that they've actually become more expensive, obviously from that almost discount that we saw during the tariff tantrum. They're also back in the top quartile of their valuation range as well. So meaning that you have a matched perspective of expensive valuations and really high earnings growth. The interesting part is for the last 20 years, if you had to decide between an environment of expensive valuations but high growth or lower growth, but lower valuations, that would actually be, it would be a better situation to be in the high growth, high valuation, which has been much more predictive historically.
Denise, over the weekend I did a lot of reading and, you know, the headline bubble comes up everywhere across the newspapers. But there are some interesting kind of points of distinction between a stock bubble and a sector bubble. So in a stock bubble, the argument is, well, you know, prices and valuations are being driven up without the fundamentals to support them. But that is different where you have an entire industry saying, we're going to keep investing in this technology, right? And in the future, we see a return on that investment. Which side of the bubble debate do you sit on, the stock or the story?
Well, it's interesting. When you look at it compared to what we went through in the tech wreck, I mean, when you look at high growth and high valuations, you say, well, that was exactly what we saw in the prior bubble. So isn't this the first early stages of that? Well, relative valuations were actually 70% higher in 2000, and you ended up with almost negative operating margins. Not only are we not negative in terms of operating margins for technology as a sector, but they're actually increasing overall, which is to say that sometimes things are expensive for a reason. And when you look at bubble indicators like CapEx, if you add up all the CapEx in the technology sector and you divide it by the sales basis or even free cash flow, you'll see that there's really nothing anomalous, meaning that as much as some of the nominal numbers are eye-popping, some of the free cash flow is also eye-popping, as is the sales. So again, it's back to that high growth is matched with high valuations. A lot of the time, what you almost see is high valuations are being positive predictors of future growth, which is usually more durable than I think investors expect.
Denise, for you right now, which primary or secondary data sets are you watching most closely for the tech sector?
So for the tech sector, I do think overall this shift between either economically sensitive sectors like technology, communication services, consumer discretionary, and the defensive sectors like consumer staples, healthcare, utilities, the fact that median earnings is finally starting to recover for the first time in the better part of 3 years is actually the best setup for those economically sensitive sectors like technology, even despite the fact that technology has already worked. It usually continues to work as the durability of the earnings story actually broadens out. On top of that broadening out story, you might say, well, are there any tailwinds that actually are positively predictive? You know, even besides the Fed cuts that we're seeing and about to still see, and the tax cuts that we are still seeing or that have seen and will bear fruit into 2026, remember, of all of the sectors, when you look at lower oil prices, which were kind of a form of a tax cut, technology is the #1 sector that outperforms after that style of a tax cut as it filters through in terms of cost to margins and potentially lower inflation that increases multiples. So I think that there are a lot of things that highlight the fact that there are more tailwinds for overall earnings growth, which is bullish for economically sensitive sectors like technology.
And how global does that data set and do those tailwinds tend to be right now, Denise?
So I would say that from a global perspective, you are certainly seeing earnings growth across the globe. But right now, you are seeing an interesting, what I would say is a change in trend from the last, let's call it 4 to 6 months, where international was accelerating and the U.S. was decelerating slightly. You are now seeing that shift, meaning that U.S. earnings, specifically led by technology, is reaccelerating at the same point where Europe, EFA, and emerging markets are decelerating. That sets up, in my mind, a better risk reward for markets, despite the fact that U.S. stocks are are much more expensive. It's interesting when you look at international versus the US and you say, well, these stocks have actually outperformed over the last 10 months, year to date, certainly, and they're still cheap. That seems like a compelling proposition. But when you look over the last, since 2010, so over the last 15 years, you'll see that that's led to 0% odds of outperformance for international, which again highlights the fact that, look, valuation sometimes doesn't say what you think it means. Sometimes stocks are cheap for a reason, and sometimes stocks are expensive for a reason. And a lot of times, valuation almost correctly predicts whether or not earnings growth is going to be durable or not. So I do think that you are seeing the U.S. be leadership from an earnings perspective again.
Briefly, in a historical context, have you ever seen such underpinnings of importance from the private market? Because yes, we worry about bubbles in the public markets, but a lot of them all go back to a few players in the private market like OpenAI.
Yeah, so I think that the places to look from a data perspective are always in the public credit markets to see what we are discounting in terms of the private credit markets. I don't have any specific insight, but when you see more stress being in high yield credit spreads than there is in the VIX or in equity valuation spreads, that's usually a negative setup. We're not seeing that so far. Credit spreads are well contained and there's still more fear in the equity market. So whenever you see headlines like that, you always have to step back as an investor and say, this could be a situation where, yet again, the market can climb the wall of worry.